Welcome to a DerivSource webinar on changing trading processes to support electronic execution of OTC derivatives via SEFS. Today's webinar is sponsored by State Street. I'm Julie Schieffer, founder and editor of DerivSource.com, and I'll be moderating the discussion today. Now, new OTC derivatives regulation under Dodd-Frank requires some OTC derivatives contracts to be executed via soon-to-be-established SEFS to provide greater transparency in this currently opaque market. Now, the model for new SEFS has yet to be firmly established. However, market participants are needing to start to prepare their trade workflow to connect, trade, and process these trades via these new execution trading facilities. In today's webinar, we have a panel of experts who are going to be reviewing how SEFS will likely operate, and they'll explore how market participants such as yourselves can adjust their trade workflow and business models to trade these OTC contracts via these new execution facilities. Now, we have a couple of different items that we're going to go through. The panel will look at how a SEF will operate, looking at asset class coverage, looking at SEF selection connectivity, as well as, again, managing this trade workflow. So we have a number of different items that we aim to get through today. But before we begin, let me first go through our panel of speakers. We've got Cliff Lewis. He is an Executive Vice President of State Street Global Markets, which is State Street's investment research and trading arm. There he is responsible for the e-exchange business, including Curenex and the Global Link suite of solutions, which provides electronic trading solutions for FX, precious metals, cash U.S. Treasury securities, futures, swaps, money markets, and ETFs. Now, Cliff also oversees State Street's FCM, which provides clearing services to clients trading futures, options, and swaps. Next, we have Neil Brady, who is the Chief Executive Officer of Eris Exchange. Prior to co-founding Eris Exchange and assuming the role of CEO, Mr. Brady served as Managing Director of Business Development at CME Group. And in this role, he was responsible for the growth of CME Group's OTC and global business through strategic partnerships, investment acquisitions, and new business ventures. Next up, we have Scott Parsons, who is the co-founder of a government affairs consulting firm called Delta Strategy Group. Now, this group provides strategic consulting, political analysis, lobbying, and business development. And prior to this role at Delta Strategy Group, Parsons held various roles in government, including at the CFTC. He was the CFTC's chief of staff, as well as the first CEO in the agency's history, and has worked with the President's Working Group on Financial Markets within that capacity, and afterwards also worked as an EVP at the Managed Funds Association. And last but not least, we have Peter Barsoom, who is the Chief Operating Officer of ICE Clear Credit, which is the wholly owned clearinghouse of Intercontinental Exchange. Now, in this role, Peter oversees all business development and customer initiatives for ICE's U.S. credit derivatives clearing operations. And prior to joining ICE, Peter was the Deputy Chief Operating Officer at Blue Mountain Capital Management, which is a multiple strategy hedge fund. And again, for the latecomers, I'm Julie Schieffer, founder and editor of DerivSource.com. Now, just a couple quick points of housekeeping before we begin. For members of the press, please do not quote our speakers without first obtaining their written permission or the permission from DerivSource. We will be recording this event and making it available within 24 hours of this broadcast, so please stay tuned for that. But also stay online until the very end to make sure that you have your questions answered. We will be taking your questions in a Q&A session at the very end, and please submit your questions at the bottom right-hand corner of your screen. There's a Q&A box there, and we'll be taking those at the very end again. So without further ado, let's begin our discussion by looking at SEFS in general and giving our audience a very quick overview of the operations of SEFS. Cliff, do you want to start us off here?
I thank you very much, and it's good to have a good group, and obviously look forward to the questions. At base, there are two elements to the SEF environment, the swap execution facility. One is tied to the regulations, particularly Dodd-Frank in the U.S., different set of regulations, different timeline in Europe. The second is really more voluntary. The second is structural changes taking place independent of the Dodd-Frank requirements. So in terms of the Dodd-Frank requirements, essentially SEFs are tied to the requirement, which Scott will talk about in a minute, terms of timing for clearing derivatives that are currently not brought into a central clearinghouse. So the change in regulation that was introduced in the first instance is a requirement for OTC swaps, interest rate swaps, credit default swaps, and some foreign exchange products, notably foreign exchange derivatives, that today are traded on a bilateral credit arrangement in this new environment would be given up into a central clearinghouse similar to futures. So the SEF is a requirement that's introduced after the clearing requirement, and it is essentially has two elements, one of which is competitive pricing, so that the requirements vary a bit between different product sets. But to take the CFTC world, we could talk about CDS single names, which is it's a bit of an outlier if we want to get into that. But for the CFTC regulated products, interest rate swaps, the foreign exchange products, CDS indexes, which make up the great bulk of the trading, you will have a requirement to do it electronically and competitively, similar to futures. What that provides is an element of transparency. Basically, the trades will have to be given up to what's called a swap data repository, where the pricing information will be publicly accessible. For those who are familiar with equities, it's similar to printing an equity trade. And similar to equities or futures, there will also be block trading thresholds, which would permit you for certain size transactions to opt out of this electronic platform and to trade bilaterally, but those trades would have to be printed, as in the equity sense, would be given up publicly, would be accessible to the marketplace in terms of information content. The final point on this is you've got the regulatory world, which I just talked about, driven by the government regulations, but you also have an even more important issue involved from our perspective for buy sides, which is a very simple point, which is essentially there are going to be a variety of SEFs, a wide range of choices in terms of execution strategy for the buy side. And really it's on the execution side that many of the incremental costs of these new changes, particularly the costs of clearing, are going to be offset by execution efficiencies. So for the buy side, the SEF is really a big part of the benefits, and it's our view that the decisions that are made on the execution side, in particular decisions made about SEFs, will really determine who's a winner and who's a loser in this new derivatives market structure. Turn it over to Scott.
Yeah,
Thanks,
Scott, would you like to give us a bit of background on the kind of timeline for regulation?
Julia, I'll be happy to do that. And just playing off of what Cliff has already said, if we look, and what I'd like to do is take a look at the U.S. Dodd-Frank regulations as well as what's going on in the EU and how they compare, because I think what happens in one jurisdiction is going to affect the other, and it'll affect where people trade, where people clear, what people actually do in this market. Given the global nature of the derivatives market these days. First, on Dodd-Frank, our latest projections are that first of all, everything, as Cliff said, works off of the clearing mandate. So in order to talk about trading and when the trades are going to be required on SEFs, we have to talk about the clearing mandate, because everything flows from that. Our latest projections are that clearing could come online and be required by some market participants by the end of the year, by the end of this year, 2012, in the U.S. at the earliest. And so if we're looking at December for mandatory clearing, then we expect that there'll be a ramp-up period where people are testing systems. I think we're already seeing some of that out there in the marketplace. That's kind of the front end. And then the trading requirement is the way it works in the U.S. under Dodd-Frank is if a contract is subject to mandatory clearing, and then a trading facility, which could be a SEF or could be a traditional exchange, offers the contract for trading, then it's required to be traded on a central platform. And there's minimum right now a 30-day lag between the clearing mandate and the trading mandate. So if you took first case scenario in the U.S. from clearing and then trading, you're looking at December and then January of 2013 for trading. A couple of key dates on the U.S. side to keep in mind. All of the clearinghouses in the U.S. have submitted the contracts that they currently clear to the U.S. regulator, the CFTC. And we expect that the CFTC will turn those contracts around with analysis and say, we think the following contracts should be subject to the clearing mandate. And they'll invite the public comment on that. That document could go out as early as next month, June. And we'll kind of start the process, which is a 90-day review between then and when they can be subject to the clearing mandate. And then different market participants will be phased in, starting with the bigger players like the swap dealers, which are the traditional banks and a few others, as well as single manager type hedge funds. And then that'll be followed in 90-day increments by other market participants like pension funds, endowments, and then those with sub-account structure will be kind of on the end of that, asset management types. In the EU, there are two different bodies of law, so to speak, that are relevant. One is EMIR, and that's the one that deals with clearing, among other things. That process appears to be lining up pretty consistently with the U.S. in terms of an end-of-year goal. It's very possible that the EMIR timing on mandatory clearing, as well as the Dodd-Frank implementation by the CFTC, could slip into the first quarter of next year, but they're lined up pretty well. On the trading side, that's not the case. The trading side is governed by MiFID, as many of you probably know, and that's not expected to be implemented until 2015. And there's some technical standards that we'll see in the coming months, but that process is not lined up with the trading side in the U.S. So I'll stop there, Julia, and if we need to add anything, anybody else can.
Okay, do any of the other speakers want to jump in here? Otherwise, the other question I wanted to go into is talking a little bit about the voice brokerage.
And I'm happy to do that if nobody has anything to add on the first point.
Yeah, that would be great, Scott. I know this is a difference between Europe and the U.S. in terms of regulations, so an explanation would be great.
There's a debate going on in the U.S. right now about voice brokerage, and is it going to be allowed in the traditional sense on SEF execution? And even the U.S. Congress has gotten involved. There's a requirement for pre-trade price transparency that some have argued that traditional voice will not be able to accomplish. And so the Congress has even introduced another bill, a legislative vehicle that would allow for traditional voice to be included in the, as satisfactory of the pre-trade price transparency provisions in Dodd-Frank. It doesn't look like that legislation is going to go anywhere. In other words, it won't be signed into law, but it does kind of frame the debate, and it's a fairly controversial element of how SEF modes of execution will be allowed in the U.S. And our guess, and others will have opinions of this, is that maybe at the beginning there will be some element of traditional voice. We do think it's going to be driven into the what's being described in the U.S. as voice hybrid, so an electronic component of that. But the goal of the policymakers is to get it away from the traditional voice mode of execution and into more of an electronic, transparent venue. And so even if traditional voice is allowed in the beginning, our view is that the policies will be incentivizing and pushing to make it more electronic and have very clear pre-trade price transparency.
Okay, great. Thank you, Scott. Now,
the only clarification, this is Neil, the only clarification I'd make around that is it's just important in talking about the debate around voice to separate out, above block trade thresholds and below. I mean, the controversial part of the part that's being talked about is what occurs, below that block threshold. And, similar to futures markets, other markets that have operated above a block threshold, that's to allow for certain size transactions to be transacted bilaterally and then reported.
That's a very good
point. But the other key difference is that in this environment, I don't think there's much debate that these blocks, even blocks, are going to get reported so that they'll be in the public domain, which is going to undermine a lot of the rationale for guys that are trying not to move the market. So the benefits of trying to do it in a block kind of environment is going to go away largely.
Okay, great. Well, let's move on to the next point. I'd like to talk about what differentiates SEFs. So you talked about the basic principles behind them now in both jurisdictions, UK and Europe versus the US, but with the kind of expected explosion of possible SEFs, I think some number such as 40 has been thrown out there in terms of expected execution facilities to be registered. I'm wondering how market participants will determine which SEFs to use. So can we talk a little bit about SEF selection here? And Neil, do you want to lead us off on this one?
Sure. Yeah. Happy to do that. At Eris Exchange, we're really kind of on the leading edge of talking to clients about selecting a venue because, as Scott mentioned with the timeline, the swap execution facility mandate, is in the future, and there's a lot of activity around getting ready for that, but the rules are not yet finalized. Operating as a designated contract market, which is one of the other alternatives for complying with Dodd-Frank. We're in quite a lot of contact with clients making, decisions around connecting to venues. So I'll talk about what we're seeing and then what we believe will be the sort of differentiators and the basic buckets that people will, use to decide who to connect to. Broadly speaking, we'd break it into four different buckets. We'd say the product area, which product you're trying to trade, which derivative you're trying to trade, the trading model that's being used by the SEF, the liquidity that's on that SEF or that's looks like it will be, on that SEF, and then the trading infrastructure on the SEF. So I'll just touch on these briefly and then kind of open it up to the others to opine. On the product side, clearly, if you're trading rates, you're trading credit, we believe, certain venues will, some will offer all, but others will specialize in interest rates or credit or FX. Interestingly, in this cleared world, the product is not only the product you're seeing on the screen or on the execution venue, but it's also pretty closely tied to the back end where that product is being cleared. And, a lot of the cost equations we see people going through today are, once I trade the product, what are going to be my ultimate carrying costs for putting up margin and holding that at a clearinghouse? So important in this decision process is, does that product have margin offsets with other futures products or related swap products? What's my sort of all-in cost, not just my execution cost there on the screen? What's going to be the cost for me to do this trade or execute this hedge? On the second bucket would be the trading model, the market protocols. Is this a SEF that focuses on, central limit order book, CLOB execution, or is it more of an RFQ model where a user will, RFQ, say 1 to 3 users? Are there streaming quotes coming for benchmark securities, or do those have to be requested and directed to specified dealers or liquidity providers? Is there an anonymous element to the execution? Is a central limit order book anonymous or not? Or is an RFQ model where there's name disclosure on the client side? Are the quotes indicative streaming quotes but that aren't fully executable, or are those more sort of future style fully executable? What you see is what you get in terms of the quoting. The third category that we see clients concerned about, and we think they will be concerned about, is the liquidity on the platform. Which dealers are supporting that platform, which alternative liquidity providers are supporting that platform, who are making the prices, who is the venue, essentially open to, or who can easily access that platform. So I think that's a key differentiator of these platforms. And then last, we call it the bucket of trading infrastructure, which means a variety of things: the front, middle, and back office integration. Does the venue have open APIs and accessible front ends, existing distribution, or front end, in future space, these are independent software vendors or ISVs? Are there credit controls so that what you see on a platform, you can instantly click and trade and get a fill and know that trade is cleared? And basically all of the stuff that goes along with real-time trade processing and even post-trade processing, which we'll talk about here later on in the seminar. So those are the broad buckets. I don't know if the other panelists have other comments, but that's what we see clients focusing on today and think they will be focusing on in the future.
Yeah, just to add to Neil's excellent inventory, I think you really see customers today falling into sort of two categories. Mostly people don't care. Are sort of hoping this all goes away, sort of hiding under their desks, hoping the government will forget about this. That's very unlikely to happen. The second category of people that are involved in this are basically looking for the simplest solution that does the least violence to how things are handled today. So a number of people are of the view, well, we've chosen this SEF, that SEF, and that's certainly an appropriate risk-averse approach towards what's going to be a very complex set of changes that are going to involve lots and lots of challenges for different market participants, some of which we're going to talk about later. I guess our perspective, what we're intrigued by is just how big a gap there is in terms of really who the SEF is organized to benefit. And this is a pretty basic point, I think, is on the one hand, you have a number of offerings which are really designed by and for the benefit of the existing dealer community, the large bank dealer community. Indeed, their pricing models show that, because essentially they charge the buy side and the money is distributed to the sell side in the form of dividends. That's one extreme example. Very popular, straightforward solution that some think is appropriate for them. On the other hand, you've got offerings that are really trying to push the market to a more level playing field, to try to push to democratize the market in a way that the buy side for the first time is going to be able to have the transparency and efficiency to be able to get better pricing than they do today. So we see a pretty big contrast among SEF models that hasn't yet translated, I think, a lot into decision-making by the buy side. But I guess my point, which is sort of clear from the way I describe it, ultimately the successful SEFs will be those chosen by the buy side, because this is really, in our view, and I think that's the experience we've seen in other asset classes like FX, ultimately this is going to be driven by the people who use these products, not by the market makers.
Okay, great. That's an excellent point, Cliff. Any other speakers want to add to their point of view before we move on? Okay. The next question is going to answer some of the questions that you guys are submitting in the Q&A panel here. We're going to look at SEF and CCP integration and how the execution via SEFs really works together with clearing. So, Peter, would you like to start us off and give us a little bit of background in terms of how you see this integration taking place from a technical standpoint and any challenges you see as well?
Yep, absolutely. So one of the new requirements under Dodd-Frank, which is different than in the futures world, is the requirement that CCPs be open access to multiple swap execution facilities. And at ICE Clear Credit, that's been our policy from the get-go, being open to even kind of before there were SEFS, but being open to multiple execution venues. One of the challenges that this means is the world is going to get a lot more complex as we have this proliferation of execution venues. And so the industry has been working, led by FIA and ISDA, on a working group called the Certainty of Execution. And the key element that working group has been trying to tackle is to ensure that at the time that two market participants are transacting on a SEF, how do they ensure that they've got certainty that that trade would be cleared and that the trade wouldn't subsequently be broken, exposing either market participant to potential market risk there. And so a key component of that is around the management of credit limits, both how FCMs will be managing their exposure to clients, but also how CCPs will be managing their exposure to clearing members. And where are credit limits housed? How does an execution venue know that somebody is authorized to clear, and how much credit does that market participant have? And so we have got a number of different potential models that are being discussed right now. We have a framework of principles. Here at ICE, we've proposed what we call our +1 approach, which has a number of key elements to it. The most important outcome, however, for everybody here is the fact that there's 100% execution certainty at the time that you execute. 100% certainty that a trade would get cleared at the time that you execute. Building upon our years of experience in OTC energy and futures market, we can take the best of those worlds and bring it to the OTC world and offer a model that gives FCMs the ability to manage their exposure appropriately, that gives SEFs the ability to execute and gives market participants the certainty that they know when they're entering a trade and they're done, that they are actually done. There's still more work to be done and more details to be flushed out working with SEFs. There's going to be significant investments in technology across the board that all players will have to make this work. But we think that this is a solvable problem.
Yeah, this is Neil. I mean, I'll add a few comments here. I mean, I think from our perspective, as a futures exchange, we participate in this industry debate from a somewhat unique perspective in that in the futures model, a lot of this connectivity because of the vertical model of futures with the one-to-one relationship between the execution venue and the clearinghouse. There's a very direct credit control relationship, and the FCMs allocate credit to all the users and sort of processes that have been worked out over the last decade. So, as Peter's mentioning, in a futures model, you have that absolute trade certainty, whether it's on a screen and it's anonymous, or whether you're executing it off exchange and you're then reporting it into the exchange. I think the complexity comes in the SEF space when you have so many multiple execution venues connecting to them on the back end, so many potential clearinghouses across products. It just becomes an order of magnitude more difficult sort of industry process to have FCMs properly allocating credit. And I think the industry's going to get there, but in many ways it's an industry working to make the swap execution facilities operate in a way that futures has operated for a while. And I think anybody looking at this realizes that in order to have for sure a central limit order book, you need to have very real-time trade acceptance for that central limit order book to even have any meaning. Otherwise, you're really talking about largely RFQ type markets without that immediate trade certainty. So it's going to be a challenge. There's a lot of work to do, and it's sort of getting a much larger set of participants to come around into a model that sort of already exists.
Now, we do have a question from the audience here that we could touch on in this particular question. The question asks, does SEFS completely bypass affirmation and confirmation processes, i.e., is a SEF trade deemed to be affirmed or confirmed requiring no further processing other than passing to a clearinghouse? Does anyone on the panel want to tackle that question?
Yeah. So the short answer is yes, that a trade is going to be deemed to be matched and affirmed at the SEF if executed electronically that way. Affirmation platforms may continue to play a role for what we call off-facility trades, so via voice or other execution methods that are not on a SEF directly. For instance, block trades, or if those are trades between market participants who are exempt from the either mandatory clearing or mandatory trading rule. And then finally, you still have non-mandatory OTC swaps where affirmation platforms can continue to play a role. As it relates to confirmation for cleared trades, the confirmation wrapper is provided for by the clearinghouse, so there really isn't a role for any confirmation providers as it relates to cleared trades.
I think a general point on this that is just that I think there's considerable confusion, Peter, about how the transition from the ISDA world to this new cleared world is going to work. You see it a lot in legals too. These sorts of questions that some of these things that really are no longer going to be necessary may continue for a while, but we also see people that are trying to get ready for the new structure completely.
Absolutely. I mean, that is a good point. And we've seen a number of sort of starts or misstarts. There was this attempt at a tri-party execution agreement, for instance, that the CFTC said was not permissible. So with any transition, there's going to be some degree of confusion before things settle down and get into a normal equilibrium.
And I guess a piece of advice to the audience is make sure your lawyers are focused on the new environment, because we've seen some very sophisticated players with very expensive lawyers who basically have missed the point about what the new environment is going to entail and require.
This is Scott. I want to add something to that. I think what's also important is to look through the noise and see what things are actually real, what issues need to be solved, and there are a bunch of them. And then there's some issues like the one Peter brought up, where there was an effort to say there ought to be trilateral agreements in place for cleared swaps. I was at the CFTC when the post-Enron, when nobody trusted anybody from a credit standpoint, and there was a need for clearing of energy swaps. And NYMEX had an offering, ICE had an offering. Not one time did trilateral agreements as a necessity to mitigate potential breakage ever come up. And so a lot of these efforts, particularly by people in the industry who don't want this to happen, are just designed to slow this down and not to really fix some of the issues. So I think it's important to look through that. The other thing that I should mention that I didn't mention earlier is all of these mandates and timelines have to assume that we have workable rules in the U.S. and in the EU for trading of SEFs, and we don't have that on either side yet. And that was a date that I should have thrown out earlier. But the CFTC is supposed to put out their SEF rules, their final rules. There's a proposal out right now, but the final rules are scheduled to be voted on in July.
Okay, great. Thank you, Scott. Are there any other points the panel wants to make before we move on?
One other point. Somebody asked. I see a question here about allocations. So let me try and answer. Allocations will still work for asset managers, and the way the process would work is that if you're going to allocate post-execution, as an asset manager, you'd have to have an arrangement with a introducing clearing member or a standby clearing member who would clear the block on your behalf, and then you could allocate that after execution, after clearing at the clearinghouse. So it is similar to how it works today in futures. It allows asset managers to continue to allocate post-execution at the clearinghouse. So we think that allocation model is fully supportable and consistent with current practices.
Yeah, if I could add, I know we're jumping ahead a little bit to the post-trade section, but I mean, to follow on Peter's comments, I mean, again, I think this is one of these areas where the industry is working hard and will continue to work hard to essentially get to where the futures market has been with allocations and give-ups. I'd put in there. I mean, I think you're increasingly, once you take credit out of the equation through central clearing, you start to disentangle execution from clearing, and people may be able to execute through a third-party execution broker with an unaffiliated desk. That's a very common model in futures. On the back end in the futures system, both at ICE or at CME, there are well-developed tools to auto allocate into the various sub accounts. We'll have this all very hard coded and worked out, and also to give up trades. I mean, something like a quarter of all of the CME trades are given up on a daily basis, which means if you take a liquidity provider as half of every trade, call it 50% of all client trades are given up. And so you'll have for example, a 2,000 lot Eurodollar futures trade, which is, in notional terms, $2 billion. Nobody thinks twice about that being just sort of seamlessly given up or then allocated in the proper accounts. It all flows seamlessly. So it's a lot of work for the SEF industry and SEF world to get there, but I think it's all, again, kind of driving toward the model that exists already operationally in futures.
Okay, great. As Neil pointed out, we're going to cover this a little bit in a different section. So just moving on, I want to talk very briefly about jurisdictional differences. Obviously, Scott alluded to this already when talking about the timelines at the very beginning of this call. But I'd like to just ask the panel generally if there are some challenges with interoperability when managing these differences in various jurisdictions related to execution as obviously OTFs and SEFs and just regulation in general evolves. And Scott, as our expert, do you want to start us off with this question, please?
Well, I'll start, but I think others are from the market side are better equipped. I mean, you're seeing this is a debate about basically if the vertical model that we've seen in futures in most, particularly in the U.S., if that's going to stand or it's not. And there's an article that came out this morning about there's a argument going on in the EU right now about how's this all going to work and does it make sense to open the platforms up, and so I would say there are challenges in figuring out how it's ultimately going to go, and I think the decisions that are made on that particular point are going to be significant for competitive purposes and how successful some of the offerings are going to be.
Okay, great. And Cliff, do you want to jump in here too?
Well, just jurisdiction is not just geographic, but the SEC and CFTC, for example, don't get along in the U.S. And the distinction between the SEC-regulated environment versus what the CFTC, you'd think that there'd be a consistent set of rules. There probably aren't going to be. And the other jurisdiction issue, which I noticed in some of the questions that comes up, is the more general point related to kind of cross-margining and some of the practices, kind of broadly speaking, that were common with a prime brokered model in terms of more general portfolio margining across a wide array of different OTC products that could be provided in the previous bilateral environment. And I guess the bad news there is some of the things that buy sides have become accustomed to getting are going to go away. And it's an open question as to how feasible any kind of cross-margining between different clearinghouses is going to be. So bottom line is the cost in terms of the amount of margin that's going to be required to be posted by both the buy and the sell side is headed up, and that again, this is another part of the factor of why people really need to be focused on the costs of the new environment.
Yeah, I mean, Cliff, to add on that, I think what we're seeing out there is an interesting element of that cost equation is what does it cost the clearing firm providing the service to you? I think one of the sort of less discussed parts in the chain in this entire regulatory move has been, what is the impact on the FCM that's providing that clearing service to you? So, different FCMs have different cost bases at various clearing houses and with different products. I think one of the real major issues we're going to see in the next sort of 6 to 18 months is how do people actually begin to allocate costs internally within the FCM and within the one providing the service, and then how does that get passed on to clients? I think that's a very dynamic issue out there today. Costs are going up, and so how do those get taken care of is another way of putting it.
Absolutely. I think that's an evolving space, and we'll continue to monitor that as regulation evolves in terms of the unintended consequences there. But just moving on to the next question, connectivity. Now, this is something that I've had a lot of questions about myself as a journalist with DerivSource. So I want to ask the panel to talk a little bit about the connectivity in terms of the challenges, but also the technicalities involved there. And Cliff, again, would you like to lead on that?
Yeah, just from a technical perspective, it will work. You have a technology aspect, you got a compliance legal aspect. At a legal compliance aspect, it'll work a bit like futures in the sense that you'll deal through an executing broker. You won't have to become a member of the SEF yourself, which will make it a lot easier. But at the same time, individual users will have the option of in effect direct market access, electronic access, perhaps bundled with other assets on a screen, or even connected through an API to automated pricing systems. That's one extreme. The other extreme, you'd have a system in which you're basically trading through an FCM. This is where the question of voice comes up as to how facilitated the trade is, how scared you are of fat fingers. It's a debate as to how quickly this is going to move. So there's connectivity in a legal sense, there's connectivity in a technology sense, but maybe the most important connectivity issue is not just front office, it's also middle and back office, because obviously as these things are done, people are going to be very concerned about STP, not just STP in the sense that that your custodian, your friendly local custodian worries about it, or your middle office outsourcer worries about it, but also very much from populating the client risk control systems. And so this is going to change greatly. In this sense, I think change for the better, in the sense that it's going to move much more rapidly to a full electronic STP kind of style.
Okay, great. Thank you.
Yeah, I mean, this is Neil.
Go ahead, Neil.
I would add on to that to Cliff. I think this is where there's going to be a lot of change. I think ultimately change for the better, but I think there's going to be some bumps along the way. I mean, if you think about today, connectivity to systems that trade interest rate swaps or, CDS indices, I mean, there really doesn't exist a community like say, in a futures landscape where you have open APIs and, a variety of front ends and private label services offering access through those APIs. You basically have either voice execution or sort of closed platforms that, may have good distribution, but they're
and Neil,
closed.
a good example of that is that some of the SEFs that sort of people are saying, well, I'm going to use this particular SEF. It's interesting to us because the particular SEF they've chosen cannot accommodate the kind of product the customer trades. It's not one of the available products, and people, I think, will discover as they go along that this is going to be tricky. That one size doesn't fit all, and better pick a SEF that's willing to work with you and has the capability to do some of the integration to your processes, rather than you having to adjust all your processes to the SEF.
That's a very good point. And the other sort of incumbents in this space are the single dealer platforms, which by by law, essentially can't operate anymore. So how do those evolve? How do they, what happens there? So you're talking about a whole new landscape of connectivity to the client that people are going to have to sort through. And as Cliff mentioned, part of this is a technological decision of are there, robust APIs? Is there a free screen that's coming from the venue? Can you access it over the internet? However you want to access it. But more importantly, it's a business decision, as Cliff mentioned. Is that execution venue really working hard to integrate into your workflow and allow you to trade the products you want to trade and the way you want to trade them, and get competitive pricing? So that's going to be a work in progress.
Okay, great. So moving on now, we are going to talk a little bit more about trade workflow. Now, we've obviously talked about credit limits as well as allocation already, but just to pose this question generally, and I see we have some questions from the audience on this too, I'd like the panel to talk a little bit about adapting both pre- and post-trade processes to support trading via SEFS. And Neil, you've talked about credit controls already a little bit. Could you start us off and give us any other information that you haven't already expressed?
Sure. I mean, I did touch on this already before, but I mean, you sort of have two levels, two basic buckets of credit controls. You have for call it a central limit order book system, or on screen. Are there effective pre-trade credit controls? Does the FCM, the one ultimately standing behind the trade, is there a system in place for them to match either by say in interest rates, DV01 sort of 10-year equivalents, or some other measure? Are they able to allocate that credit, and so that what you see on the system is fully backed and guaranteed by a clearing firm and ultimately the clearing house standing behind it, so they can have confidence in trading electronically? That's particularly important in a central limit order book environment. It's also quite important in an RFQ environment as well, but it's a different set of challenges. And then you have the sort of post-trade credit controls for trades that are executed in a block fashion. And in that case, it's important also to have certainty that, if you have to report it within 5 minutes or 15 minutes or whatever the time frame ends up being, to know that once you've accepted it, once you've reported that trade to the clearinghouse, that that it's good. I mean, because basically the market will cease to be able to function if people don't know that they have that kind of trade certainty, that the once they've traded, they know that they're good. So the challenge with credit controls broadly is going to be, to do this with a limited number of participants is one thing. To provide that type of credit control and real-time trade checking and real-time trade acceptance across a broad number of SEFs and several clearinghouses on the back end, that's where the challenge lies. And I think, Peter, you're directly involved in that debate today and working on it from the clearing perspective.
Yeah, I think you summarized that very well.
Okay, well, we have a couple questions from the audience here. They're a little bit post-trade-esque. So one question is, how are the post-trade services handled by SEFs like termination? So I know this is a very general question, but does anyone want to take on the termination question specifically?
Yeah, in a world of clearing, kind of terminations go away. So the way, unlike the current OTC swaps world, where novations and terminations are a normal course of trading, in a cleared environment, basically you just put on new trades and then they get netted to close out with existing positions. So to the extent that there are still non-cleared trades, for instance, those one could still novate away. But as it relates to cleared trade, the concept of terminations no longer.
And I think Peter, I think it's a huge benefit of moving into the cleared environment, because one of the reasons you see these huge numbers of outstanding notional open interest in OTC swaps is because it was very difficult, in fact, to get out of a swap. You'd instead, to manage your overall portfolio, you'd do another swap. Now, in the new environment, you're going to be paying a maintenance charge for all of those lines that are outstanding. So there's going to be much more pressure on compression or tear-ups. And frankly, that's not something many SEFs are focused on. And probably the biggest initial requirement for the SEF will be to facilitate tear-ups, to be able to compress so that you don't have to bear the cost of all those lines. So I, again, urge people to be careful to look at the functionality that people are pitching to see that it matches with where you really need to focus.
Yeah,
Absolutely.
I mean, just to add on. To add on to that, not only is there a maintenance charge that's going to be tacked on there from the clearinghouse or already in place, but also in terms of Basel requirements, as many of the sell-side participants here on the call are, I'm sure, well aware. I mean, the working framework is to charge based on gross notional outstanding. So that even if there are substantially risk offsetting trades on a dealer's books, there's going to be a capital charge from Basel. I mean, that's we hear about that a lot.
Well, I mean, the point that Neil's making is just to go right to the chase. I mean, the environment that the dealers are going to move into over the coming years is going to be capital prohibitive for the existing model to continue. They have to move to a cleared environment because it just won't work. And that's not optional. That's got nothing to do with Dodd-Frank or EMIR. That's Basel III, and every bank is going to have to deal with that. So the market is going to change one way or another.
And then the last thing I'd say to Cliff's point, I mean, I think this is one of the huge benefits of moving to a centrally cleared model, that you can unwind or terminate, in and out with, you can unwind a trade in an Eris futures contract or a swap that's cleared, with a different dealer, a different liquidity provider. You don't have to go back to the one that you entered into the trade with. What we ultimately think is also these kind of costs and issues are going to drive is a change in trading behavior. Once you start getting charged for line items and charged for maintenance fees, and dealers are getting hit with Basel charges, we think the sort of trade-off between trading a more standardized product that gets you close to what you were achieving with a more customized product, the benefits start to outweigh the costs, and we actually believe people will start to trade around more liquid points on the curve at forward, standardized forward starting dates, potentially, eventually moving into even fixed coupons at standardized dates because of all these back-end charges going on, which then would facilitate the unwind issue and the termination, because once you've pooled liquidity and concentrated it at liquid points in the curve, then you can bring up your SEF screen or your future screen, and you can see a liquid quote, and you can move in and out of that and collapse in net positions, on your own without having to sort of schedule an unwind session.
Okay, perfect. We've got one other question. In fact, we've got just a couple or a few questions on collateral. One of the questions that I just wanted to approach to you guys is how will a SEF send collateral information in real time?
Well, I think there's some confusion, and it's easy to get confused. But there's a clearing world, and collateral management, collateral movement is going to become a very big deal because collateral is going to be key to all this. That's part of the change to clearing. But SEFs are really on the execution side of things. Now, SEFs can provide value-added services, but really the collateral information is going to be between the clearing firm that you select and then you. Basically, I'm thinking of it from a buy-side perspective. Obviously, sell sides and market makers have a similar set of questions. But even in the most optimistic scenario, the incremental amount of collateral required is going to be immense. Not so much a SEF workflow problem, though.
Yeah, and exactly, that is between the clearing member and the client and the CCP. And the question suggested that there's a GTR requirement. There's no collateral requirement as it relates to the trade repository or SDR.
Perfect. Thank you, guys. So unless there's any other questions or points to make on trade workflow, I'm just going to move on to the next one. And we will be taking some questions from the audience, so please stay on the line for that. The next question is really looking ahead. So this is basically an opportunity for us to ask the panel how they believe the SEF space is going to develop. Maybe they can air their concerns or challenges that they see within their own institution facing down the line, or what keeps them up at night. So starting with Peter, do you want to give us your point of view first?
If you're talking about what keeps me up at night, I think there's still a lot that's uncertain. And the couple of things that do concern us is, Cliff said this very well, the lack of coordination between the SEC and the CFTC, particularly how slow the SEC has been and unresponsive to market participants is disconcerting, and we recognize, that the staff on both commissions are overloaded with quite a lot of work in a very short period of time. The CFTC, has been doing a lot more in terms of publishing rules, having periods of comment, so on and so forth, and the SEC has not been nearly as forthcoming kind of on a couple of these key dimensions. So we're very worried that this market, which is a global CDS market, and operates and has operated well throughout periods of crisis, could significantly suffer under this split jurisdiction system. I think the SEF rules are still, like I said, we had the first set of rules that came out last January, and so a lot will be determined once the final rules come out this summer. There were a number of I think issues, and we don't have transparency at this point in time to see if some of those issues kind of will be resolved favorably when we see a final set of rules. So those are the things, at least from our perspective, that keep us up at night.
Great, thank you. Thank you, Peter. So moving on, Neil, do you want to give us your 2 cents, please?
Sure. I mean, what keeps us up at night, both from concern, but also as an emerging venue here with solutions to some of these issues, keeps up at night just being busy from people, looking at what we're offering. Is I think to Cliff's earlier point, the sort of market forces that are potentially driving all this into a centralized cleared environment and potentially even an exchange-traded environment ahead of the regulatory pace. I mean, if you look at what's going on in Europe, that's certainly not trending towards more stable counterparty credit environment. You've got, looming potential downgrades coming from some of the rating agencies. And so you have, what we're seeing is buy-side folks, quite concerned around and managing what happens in the case of substantial downgrades and continued uncertainty in Europe. And you see some of the volumes in the clear products going up. We believe that it's very likely that some of this races ahead of the sort of official stated timeline from the regulators around when this rule will be finalized or when this mandate will kick in, just driven by market forces. Ultimately, we think there are many bumps along the way, but we believe the sort of ultimate SEF framework will deliver a lot of benefit to end users. I mean, if you look at just the sort of the transparency and the cost savings that came out of the invention of Treasury futures years ago, the sort of the bid ask went from an eighth down to a 64th today in the future space, and that's a 85% reduction in bid ask. And meanwhile, the volume in Treasury futures has gone up tenfold, where they trade 1.5 million, 2 million contracts a day. So that will take time to get there. It's not going to happen overnight, but we think ultimately more competition, more platforms to choose from, and then centralized clearing ultimately will deliver benefits after this migration occurs, benefits to end users.
Okay, great. Thank you. And Peter, do you want to give us your 2 cents?
Yes. Oh, I already did.
Oh, sorry, Neil then.
It's okay.
Not Neil, Cliff.
Sure. I guess my general point we've alluded to, which is this transformation we're looking at has big opportunities for efficiency gains that hopefully can offset some of the inevitably higher costs, whether it's associated with collateral, however you look at it. Things that today in an OTC environment are nominally free. In fact, you're paying, most cases, a lot of money for the execution service, for the liquidity, are going to actually move to an environment more similar to equities, where you're going to be paying brokerage. And the question is, will the buy side drive a hard bargain with the sell side? How aggressive will the buy side embrace the potential efficiency gains from the new SEF opportunities is really, to me, the key question. I think over time, those that do embrace the opportunity will succeed. Frankly, those that don't embrace the opportunity will probably not be successful asset managers. I think this will become a major differentiator in terms of performance, not for no other reason than purely cost. I think the kind of order of magnitude transformation you're seeing is similar to what's happened in the equities markets over the last 20 years. And indeed, I think that's really what the regulators want to see happen. They want to see this go to a market where you have access to an incredible array of liquidity, ultimately, frankly, to buy-side, trading with buy-side, and not requiring the kind of intermediation services that are provided today. Now, that's a long way away, and in some ways, maybe in reality, never do you quite get there. But the simple fact is that I think everybody needs to be worried about cost, I guess, is what it all comes down to. And I think there's a lot of questions are as to timing and how much on SEF, how much off SEF. But I think that in the short term, I think the markets are going to be hit very hard because of these costs. And the question is, hopefully the miracle of the marketplace and innovation and entrepreneurship will provide the kind of solutions that offset the kind of regulatory burden that's being imposed. Otherwise, I think a lot of the what goes on today is just going to go away.
Okay, great. Thank you, Cliff. Now, I want to take some questions from the audience here. So just moving on to the next section. One of the questions that has come up is looking at the 15-second rule, and that's something as well as the 5-quit minimum when, and I assume this comment is with regards to RFQs. Does the panel want to talk a little bit, just very briefly, about the 15-second rule and kind of the status quo with or opinions on the 5-quote minimum?
Scott, do you want to take that one?
Yeah, I can start, and I think Peter has alluded to this already. There's an out-trade, so to speak, between the SEC and the CFTC on the number of participants on an RFQ basis that you have to go out to. The CFTC has said 5, the SEC has said 1, and so there's a big difference in that, because if the policy decision was made that it's just 1-to-1 on an RFQ, then the world may not have to look much different than it does today. We don't think that that's ultimately going to prevail. That it'll be more of it'll be closer to what the CFTC is asking for there. And then on the 15-second rule, this is in line with the pre-trade price transparency of making sure that these markets are transparent. and I think one other thing, just to add to what other people have said, and other panelists may want to come back to this particular question, is I think regulatory certainty is something that is extremely key here. And the business question that I've been thinking about, and others may have comments on, is let's say that the trading mandates don't line up in the EU and the U.S. Does it even matter? Once we get to a clearing mandate and market participants, particularly on the buy side, are able to focus on the execution offerings, and I say focus, I think they're more focused right now on clearing, but because there's just so much that you can do, there's so much you can handle. A lot of moving parts here. But once we get to the clearing mandate, or there's certainty about getting to the clearing mandate, and we get rules in place that establish what the minimum RFQ number of quotes will be and what the block sizes will be that Neil talked about earlier, the people say, okay, if we've got to clear these trades, then why not go ahead and trade them as well, since we're already clearing them centrally?
Okay, great. One question that we had from the audience alludes to SEF selection. The question is, how much liquidity each SEF will attract is yet to be seen. Given that, how can firms decide who to connect to? Cliff, do you want to take this one?
Yeah, I mean, I think that's really going to be driven again by the price takers on the SEF. If enough important price takers insist, then their liquidity providers will participate. It's not a static outcome. There's certainly an effort on some of the large market makers to try to limit customer choice. It'll be very interesting to see how this plays out, and this is sort of ground zero on a lot of these regulatory debates. But the bottom line is, I think that from a buy-side perspective, it's going to be very important to have as broad a set of market makers as possible participating. Indeed, that liquidity increasing is what we should really be after. And, of course, that's enabled by this clearing solution, which means that you can trade with people, in effect, on a price that you would never have signed an ISDA with. That's the genius of clearing. It turns everybody into a AAA. Makes it hugely more efficient, as Neil alluded to. And I think that basically, we've watched this in a voluntary environment in FX, and I just would urge people to stick to their guns. Make sure you get the solution that works for you, and the liquidity providers will follow their customers.
Okay, great.
Yeah, just to echo Cliff's comments there. That what we're seeing is people who, larger players that they're looking at it and seeing this is a very important moment in sort of market structure to come out of this transition on the right end with a functioning market, are taking the time to say, I want to support venues where the widest possible group of liquidity providers can participate, because as the dealer community, is taking less risk, and that's just shown in statistics like corporate bond inventories and others. I mean, it's no secret that trend is going to less liquidity provision. Some of the guys who are on the forefront are looking out and saying, how do we make sure that there is a community of dealers and others coming into this so that we can sufficiently get our business done. So as Cliff said, I think it is largely up to the end users of the products to be very conscious about their choices and supporting venues that think will promote a better market at the end of the day.
Okay, great. Now I've got one other question which I don't think anyone really has the answer to, but I'm going to ask, and if someone from the panel wants to give their 2 cents. The question is, the focus right now is on Dodd-Frank, so is the expectation or hope that MiFID regulation will follow or be in line with Dodd-Frank requirements? Does anyone want to take a stab at that?
Well, the timing, I think Scott alluded to, the point with MiFID as opposed to IMIR, I think MiFID is so much later that the likely outcome, and this is not meant to be particularly chauvinistic, the likely outcome is that market practice will have been determined by the time MiFID comes in place, so that MiFID, I think, is less important in that sense, only because once best practice is determined, I think that will become something of a global process.
Excellent. Thank you, Cliff. And I did realize that I left Peter out in the final 2 cents. So, Peter, as kind of the regulatory expert on the panel, do you have any last-minute points of concern or challenges that you want to voice in terms of how you see the SEF space developing?
I think that's for Scott.
Yeah, go ahead, Scott.
No, I think Julia, I think I got that in. I think the only thing that keeps me up at night is I have a 10-month-old daughter. I sleep pretty well other than that. But I think it's regulatory certainty, and I think Cliff's point is the one to think about. Even if the timelines don't line up on trading, on mandatory trading, if they line up on clearing, and it looks like they probably will, and this is outside of us having a market event. And if we have a market event that drives people to clearing just from a market standpoint, which we're kind of seeing now, but it could get worse, and meaning the process could accelerate. So I think the government role here is important, but as Cliff said, it may not even be necessary, because markets may determine what the best practices are going to be, particularly once we get to clearing, and then it may just take off on its own.
Okay, great. Thank you, Scott. Now that concludes our event today. We hope that you found the event and the topic informative, And thank you to our audience. We had almost 400 in attendance, so apologies that we didn't get through all of your questions, but hopefully we got through most of them. I want to thank our speakers here. We have got Cliff, Neil, Peter, and Scott. Thank you very much for sharing your insight and your top knowledge with us today. Thanks also to our event sponsor, State Street. Now, just a quick point, we do have an end-of-event survey. So what it does is it pops up when you close down the platform. It's only about 20 seconds, multiple choice, so please fill that out and let us know what you think about today's event. And, of course, if you're not already a registered member of DerivSource, please do register. It's free, and you receive evites for future webinars as well as access to all of our online content. So thank you again to our attendees, to our speaker, and to our sponsor, State Street. We'll see you next time.